Yeah! What is up, Patriots? What is up? Hope everyone had a great weekend. Welcome back to Military Money Mondays. Yes, it is that time again. It is Monday night, time for Military Money Mondays, the live stream where we talk about how we help our nation's heroes, and that means service members, veterans, first responders, and patriotic families. We help them build wealth, protect their families, minimize taxes, and create lasting legacies. So I'm your host. I'm Dan Farnsworth. I'm the owner of VictoryX Financial. I'm a retired naval officer, and I founded this agency to help give back to the veteran community that gave so much to me during my 23 years of active service. So what are we going to talk about this week? Well, we posted a video back on the 11th, and this was on YouTube. And the video took off. I mean, it really went viral. We had over 12,000 views since last week. We booked a ton of appointments. And basically the video was all about how to help veterans triple the value of their VA disability compensation. Okay, so think about this, right? You've got a lot of veterans out there, myself included, right, who are receiving some form of compensation from the VA as a result of conditions that we've incurred as a result of our service, okay? So we wanted to, we set out to figure out how can we, as a financial agency, how can we help veterans to really accelerate the benefits that they're receiving? Because we saw the first problem, and the first problem is that benefit is only going to last as long as they do, right? So at the end of their life, at the end of, potentially my life and every other veteran's life, that VA disability comp is going to come to an end, and it's going to cut off their family from that stream of income that veteran worked to earn, right, as a result of their service. So how can we preserve that, right? How could we keep that benefit, going? How could we make it last longer than they do, right? How could we turn that into a foundation for generational wealth so that it keeps on paying long after they're gone? And then on top of that, what else can we do to really multiply the power of that benefit? So if you guys haven't watched the video yet on YouTube, go check it out. I'll put the link in the comments section down below. Go check that out. The video is called "Triple Your VA Compensation," and you'll be amazed at what we were able to come up with and how we've helped so many veterans just in this short period of time be able to triple or more the value of their VA compensation. So let's go ahead and go down to the screen and let's get into the topic tonight, because this needed a follow-up, okay? We needed to get back into this, and we needed to answer some questions because we got a ton of them, okay? We got emails, we got comments, we got YouTube comments, okay? And a lot of questions out there about how this system works, how we're doing it. Is it a scam, Are we being unethical with this? We're going to talk about some of those questions here tonight, and we're going to talk about why this program is superior to some other financial vehicles that you may be more familiar with. So let's go ahead and go down to our presentation and let's check it out. All right, so here we go. So part 2 of the Triple Your VA Compensation series. Again, this concept, this video, our last webinar, our last live stream that we did were so popular that we decided to come out with a part 2, right, where we answer your questions and we dive a little bit deeper into these strategies. And my guess is we're probably going to end up doing a lot more of these because, again, this has just been so well received by the veteran community. So we expect to see a number of these type of videos where we get into these strategies even deeper. So we're going to look at some pressing questions tonight that we've gotten from veterans, I would say nationwide and also around the world, that were ready to take control of their financial futures. So let's go ahead and get into it. So the first thing we wanted to do was we wanted to kind of set some ground rules, some expectations, okay? So the first thing about this strategy, whether you're asking whether this is ethical, whether it's legal, et cetera, right? The first thing to note is that this is not a get-rich-quick scheme, okay? We're not going to put veterans, our nation's heroes, into high-risk financial vehicles, namely things like, I don't know, like crypto and some of these others. Okay, not to disparage those, we do offer some of those solutions, but that's not what this program is about. Okay, I am not about to put somebody in the equivalent of the casino to try and, triple their benefits. That's not going to happen. Okay, so we're not looking to get rich overnight. This is a very slow, steady, and very safe growth vehicle that's going to protect your principal against any market downturns in the future. Okay, secondly, this is not a scam. Okay, everything that we're going to discuss here and everything that we've discussed in the original video is grounded in IRS code, okay? That's IRS code 7702, 101A, and 72E. It's all within the TEFRA, DEFRA, TAMRA guidelines, and if you don't know what those are, I'm happy to provide some additional information. So while we're going along here, go ahead and post your questions in the comments, as always, okay? I will get to every single question, I promise. It may not be during the course of this presentation, but I will certainly get to it afterwards if I don't answer right away. So questions in the comments, and again, whether you're watching on Facebook or YouTube, let us know where you're tuning in from and what questions you have. All right. So again, I personally use these strategies. Okay, I've been using infinite banking and whole life insurance for about 16 years now. I personally have, experienced a great deal of financial success from these type of strategies. Okay, but I also acknowledge that again, they're not designed, to be the equivalent of winning the lottery. Okay, that's not what we're after. Remember, winning the lottery is a great way to get rich, but it's also a great way to get poor too. Okay, so we're not trying to do that, right? This is all based on math and it's based on historical data. Okay, when these policies, when the index strategies that go into the policy design and the offerings from the insurance carriers that we deal with, there is a great deal of research. An incredible amount of research that goes into designing these index strategies. So some of these strategies are a little bit more aggressive than others. Some of them include, accelerating bonuses with the strategies themselves. Some of them, even include protections against a 0% floor, okay? But every single one of them is going to protect your principal against market downturns, so you're never going to have to worry about losing money in any of these, okay? So let's continue. All right, so let's talk about the stereotypes just for a second, okay? We got some feedback that was talking about veterans living paycheck to paycheck. I literally got a comment on YouTube that said, oh, well, a lot of veterans live paycheck to paycheck. Okay, well, first of all, that's pretty presumptive, okay? And for as far as I can tell, I mean, it's factually wrong, right? We've had an outpouring of support and interest in these programs, in this particular program over the last several weeks, from a number of veterans who were doing much better than living paycheck to paycheck. Okay, they were like beating down our door, to get into this type of a program and into this type of a strategy because they did see the value in it, and they weren't just living, on the poverty line. Okay, they weren't struggling to make ends meet. And the fact of the matter is that if we hold on to stereotypes like this, it holds our entire community back. Okay, this does not do anything to advance the cause of veterans in this country, right? Veterans are not victims, right? We are not victims of our of anything for that matter. Okay, we all voluntarily signed up. We served our nation honorably. And when people in the financial industry just assume that veterans can invest, all that does is just perpetuate the stereotype, and it just becomes a self-fulfilling prophecy at that point, right? Because it creates this defeatist mindset. So we need to break free from that, okay? We need to start thinking in terms of, veterans possessing the discipline, the strategic thinking, and the long-term planning skills that really make us all ideal candidates for these type of strategies, for sophisticated wealth building, and we need to start acting like that, okay? So we need to start embracing that as a community. All right, off my soapbox. let's go ahead and get into what are some of the questions we're going to cover here tonight. Okay, so the first question that we had received was, what if I'm 60 years old, right? Does this still work? I even got one that was 80 years old, okay? But we'll talk about whether are you too old if you're 60 years old for this type of a strategy. What if my health is poor, okay? Because we know when we're dealing with life insurance, right, that, health and underwriting do play a significant role in whether you'll be insurable, in the insurance costs, right? So the question came, well, what if I'm in poor health, right? What if I'm diabetic? What if I've got heart conditions? What if I've got cancer, right? These are all types of, great questions, and we do have answers for those, and we're going to get into that. Okay, we've also had a few questions about whole life insurance, okay? Why do we not use whole life insurance, which in some cases we can, okay? But why do we not prefer to use whole life insurance? Why do we use indexed universal life in this particular policy? So we're going to kind of look at some of the outcomes and compare those two insurance vehicles. And then, of course, the burning question, the one that you guys are going to want to stick around for, is going to be the big one. Why not just stick to the 401k, the IRA, the Roth, or the TSP, right? Because these are the financial vehicles that most of us are familiar with. So why would we not just stick with one of these? Why not just put the money into a Roth IRA or a traditional IRA as opposed to doing this type of strategy? So while we're at it, talking about what we're going to talk about later, if you guys stick around to the end of this video, and you comment the word wealth, I'm going to send you a free copy, okay? Comment the word wealth down below in the comments section there. I'm going to send you a free copy of our RETIREMAX ELITE book. This book, you can see there, I am the author, right? Daniel Farnsworth, that's me. I am the author. Okay, this book is for sale on Amazon. I think it's around $13, something like that. But you don't have to pay $13, right? Because I'm a generous guy, and it's a season of giving. So I'm going to send you a free copy, and guess what? If you comment wealth down below in this video thread, in this comment section, and only in this comment section, I'm even going to cover the shipping costs, right? Normally, I prefer to have some skin in the game, but tonight, if you comment wealth down below, I'm going to cover the shipping costs, and I will send you a copy of RETIREMAX ELITE. It's 100 and some odd pages. The Veteran's Guide to Tax-Free Wealth and Financial Freedom. You will have a copy show up at your door this week. Comment wealth down below. You're going to get a free copy. All right, let's keep it moving here. So what does this strategy look like if I'm 60 years old? Okay. Well, the short answer is, looks pretty good, actually. The strategy can be pretty powerful at 60 years old, okay? Assuming especially if you're in good health and, you still are fairly active, right? And we can, simply, we've got possibly extra money to invest at that point. Maybe we've eliminated major expenses like mortgages or college tuition for the kids. Maybe we paid off, student loans or large debts by then. And so now we're really focused on maximizing income in the near term, right? We're talking about like within the next 10 years, right? We want to maximize income. So we're simply going to redirect a portion of that VA compensation into a strategy like RETIREMAX ELITE. And we want to be able to benefit from that for the remainder of our time on Earth. And then we want our families to be able to benefit from that long after we're gone, right? For multiple generations, not just one, right? Not just so that your wife can have or your husband can have, an income for the rest of their lives, but your kids, your grandkids, your great-grandkids, the list goes on and on, okay? We want the generational wealth to continue long after you're gone so that your service to this country becomes a legacy, okay? So what does it look like? So we broke down a scenario involving a healthy 60-year-old. Okay, 60-year-old veteran, if they were to implement this strategy today, so let's say they were getting, I don't know, we'll call it 80 or 90 or even 100% VA disability, right? So maybe they're getting over $3,000 a month of VA compensation, and maybe they don't necessarily need that full $3,000 a month, right? So maybe we can take, let's say, $1,000 a month from that, right, which is already tax-free to begin with, but let's say we take $1,000 a month and we redirect it into the policy. Now, when we do that, we're not losing the access to those funds, okay? That's what differentiates that first and foremost from your typical 401ks or IRA accounts, is that we're not losing the immediate access to that. Now, obviously, if you're over 60, you're going to have penalty-free access, but in this case, we want to be able to still leverage the funds and still grow them at the same time. In a 401k account, if I put $1,000 in, and let's say I pulled, $500 out, well, now I'm only earning compounding interest on $500, right? I've depleted my principal. In this strategy, I don't have to worry about that, right? If I've got $15,000 or $20,000 of cash value in the policy, and I want to take a policy loan for, let's say, $5,000 or $6,000, I don't have to worry about depleting my principal. I'm still earning compounding interest on the full $20,000. Okay, so in this case, we're planning on contributing $12,000 per year. Okay, and we're going to do that for just 10 years. Okay, so total invested $120,000. Now, the first thing that you're going to notice is that from day one, this veteran is going to get a $240,000 death benefit, okay? And all the critics of life insurance will talk about the cost of the insurance and, blah, 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 right? Well, let's not discount the fact that from day one, right, he puts in $1,000 in that first month, right? $1,000 in that first month, and if, God forbid, something were to happen to him the next day, his family is going to get $240,000. Right? That's a huge return on an investment. Now, obviously, that's the sad way to get it, right? I don't want to have to get it in the form of a death benefit right away. But the fact of the matter remains is that he then has that protection. And more importantly, his family has that protection. Okay? They never have to worry again. For the rest of his natural life, they never have to worry about losing his stream of income, because from day one, they've got that protection. Okay, so then after 10 years, in this case, he's been funding the policy at, let's say, $12,000 a year. His death benefit, in this case, we've kept it level at $240,000. We don't want the cost of the insurance to go up that much, and that's an adequate amount. Could we have more death benefit? Sure, we could have more. But, 240 was kind of that minimum sweet spot where the IRS allows us to get away with it. We've minimized the death benefit, but we've also provided adequate coverage for his family, and we've done it very cost effectively. All right. Now, at the end of the 10-year period, our veteran is going to have a projected cash value. Again, this is a conservative estimate, a projected cash value of somewhere between $140,000 and $150,000. Okay, and the way that we design this policy, again, the critics will cite the cost of the insurance. Well, here's the reality. The way we've designed the policy, the insurance cost on an annual basis is only going to represent about 1% of the total cash value, right? 1% of $150,000 potentially, okay? And it's actually going to get cheaper from there, right? Have you guys ever heard of an insurance policy that got cheaper as you got older, right? We think about insurance getting more expensive. Well, in this case, the way that we design these policies, again, for veterans in the RETIREMAX ELITE program, the cost of the insurance actually gets cheaper as you get older, okay? And the death benefit continues to grow, and as well as the cash values continue to grow tax-free. And again, they've got downside protection. So any market dips, whether we see another housing crisis, obviously we hope we don't, right? But if we see any other drops in the market due to, global conditions, outbreaks of war, et cetera, anything that kind of shakes the investor confidence out there and cause the markets to dip, to include political, forces, influence. These people, this veteran doesn't ever have to worry about it, right? He knows that his principal's protected, right? And his death benefit, most importantly, is still in place for his family. Okay, this isn't theory. These are real projections based on current products that are designed specifically for this purpose. Okay, so now doing nothing. Right? What does doing nothing look like? Well, if he did nothing, he'd still get the $12,000 a year, okay? Because it's, this is money that's been awarded to him, right? That he's getting compensation from the VA. So if he did that, let's say he lived to be age 85, right? We use that as kind of a benchmark. And I know I've gotten some smart aleck comments in the YouTube comments about, age 85. But here's the deal, right? Life expectancy has only gone up over the last century, right? And it is not out of the ordinary for people to live well into their 80s and even 90s and even close to 100 these days, okay? So we use 85 as kind of a benchmark, right? If we used anything less, right? If we used 80 as a benchmark or 75 as a benchmark, we're rolling the dice at that point, right? We're rolling the dice that you're going to run out of money if you live to be 81 and you were only planning to live to 80, okay? And we don't want that to happen, right? We want to know what our income is going to look like if we make it to 85, and that's why we use that as sort of a metric, a standard metric for calculating this. So let's say he lives to 85. Well, if he got $12,000 a year for 25 years from age 60 to 85, he would receive about $300,000 total. Now, there's no growth on that, right? I mean, he might get some cost of living adjustments, but, the money's not going to accelerate. What are you going to get, a 2% maybe? 1.5% cost of living adjustment? Okay, great. So you maybe got, goes from $1,000 a month to $1,020 or whatever, So, but there's no real protection with this, right? There's no legacy. If he passes away at age 65, that benefit's gone, right? His family loses the income. The income itself, if it does push you into a higher tax bracket, it can become taxable, okay? And really, like I said, there's zero death benefit for the family. But if you use this strategy, like what we just described on the previous screen, we can even go back to it, okay, where we're going to fund at $12,000 a year or $1,000 a month for 10 years. So we're going to put in a total of $120,000, okay? We're going to put in a total of $120,000. Starting at age 71, he's going to start drawing $12,500. Again, conservative estimate. $12,500 a year tax-free from the policy, okay? And then the important thing is that he also, that same year, reclaims the original $12,000 that he was putting into the policy the whole time, okay? So now his combined income, again, tax-free, $24,500 from the $12,000 he was putting in before, plus he still has the remaining, VA comp balance that he was also receiving the whole time, okay? He wasn't putting the whole thing into the policy, right? He was just putting in a portion of it. So he's going to get that all back, right? His total tax-free income just in a 15-year period alone, right, just from ages 71 to 85 is now going to be $367,000. Okay, so we're already up over $67,000 from what he had received or what he would have received if he had just simply done nothing, right? If he had just simply taken the income, we're already up $67,000. But then, right, then comes the kicker. We add in the $100,000 remaining death benefit, right? Because the policy loans are all going to be paid off by his $240,000. So now he has over $100,000 that's tax-free that's going to go to his heirs. So if we add that $100,000 death benefit into the $367,500, almost $370,000, right? We have nearly $470,000 from $120,000 invested, and he started at age 60, okay? So for all the naysayers that say that IUL can't work if you're over 50 years old or 40, whatever, there it is. Black and white, it's pure math. At 60 years old, he literally was able to more than 3 times the amount of income. Okay, more than triple the amount of income and the amount of total death or total benefit, right? Total retirement benefit from his VA compensation. Okay, it's almost 4 times the value of just doing absolutely nothing. All right, so again, one of the most overlooked advantages is the immediate death benefit, right? He gets that $240K that's guaranteed from day one. Okay, it's 100% protected. And again, if something, God forbid, were to happen to him, after he put in his first month premium, his family's going to get $240,000 immediately, pretty much, within a couple weeks, right? So, all right, so on to the next topic or the next question. What if my health is poor, right? What if I have service-connected disabilities? Many veterans do, right? I do, right? And so do many other veterans. What if I have chronic conditions or significant health challenges? Would I automatically be disqualified? Would I even be able to participate in a program as valuable as this? And the answer is you still have options, okay? Even if you're in poor health, right? Even if you have, chronic issues, even if you have cancer, right? Which we obviously hope you don't. But even if you did, you still have options where you can still benefit from programs like this, specifically this one, okay? We have specialized underwriting that's designed for this, okay, that accounts for unique health profiles. And we also have secondary, tertiary options that we can turn to if we need to even extend beyond just specialized underwriting, okay? So let's go ahead and take a look at this. So the first one that we have is a program called VetLife, okay? And VetLife is basically a program that was designed for veterans, okay? It's a specialized underwriting program, right? That was designed with the veteran community in mind, okay? So it considers service-connected conditions, right? So it was designed knowing that veterans often have medical histories, right, that civilian underwriters don't particularly understand or that they give proper consideration to. So this program is going to account for some of those, we call them veteranisms, right? Some of those issues that we see on more of a recurring basis, whether they be PTSD, whether they be, orthopedic problems, even blood pressure, et cetera, right? And there are many waivers that we can have that will be applied by this type of a program that would have otherwise, been conditions that would have resulted in automatic denials, right? Or severe health risk rating penalties that would have made the insurance almost unaffordable, okay? So it's very realistic. Again, this is a specialized program. It is exclusively for veterans, and especially those facing unique health challenges. Sleep apnea is another big one, surgeries, hearing loss, other impairments that sometimes can be detrimental when we're evaluating these type of policies. Okay, now let's say we get to the point where we've exhausted all underwriting efforts, and it just so happens that, maybe the chronic condition or maybe whatever the health condition is just simply uninsurable, okay? That is a reality. It does happen. We do get denials from time to time. There are certain conditions and certain, medical issues that unfortunately are going to be disqualifying from life insurance because it's just too much risk for the insurance carrier. So in those cases, what we typically would look at is what we call a surrogate strategy, okay? So if the veteran can't be personally insured, we can actually structure a policy to insure another individual with the veteran, him or herself being the policy owner, okay? So what does that mean? Well, it could mean insuring a spouse. It could mean insuring a child. Either way, the veteran controls the policy. You own the policy, okay? You still own the cash values. You have full control over all decisions that are made with it, also access to cash value. You get the same tax benefits, right? And the same tax-free, access to the policy values. And you do still create a tax-free inheritance. Now, it's not going to be in the same fashion as if you own the policy, right? Because the death benefit is not going to be on you. But let's say the death benefit is on your spouse, right? Well, your spouse may not have you may not have the death benefit, but you still have the cash value that's attached to the policy. Now, your spouse still has the death benefit, okay? So if something happens to him or her, obviously there's still that protection there. But if something happens to you, right, in the process of all that, your spouse is still going to have the cash value, right, that's still going to be tax-free in the policy that they're going to be able to then assume control over at the end of your life, right? So again, they're still going to have an inheritance regardless. It may take a little bit longer to fund it, but you'll still be able to accelerate the growth on the cash value. So hopefully, if we do this right, we fund the policy right, we use the dynamic banking, it won't take very long, and pretty soon you'll have a death benefit that will be commensurate to what you would have had if you had been insurable. Now, is it ideal? No. I mean, it's not ideal. But again, given the reality, right, and given the considerations, it's still a far superior strategy to just simply getting a VA benefit and just spending it and having it go out the window, right? We still have the option to accelerate the growth on that benefit. We still have the option to, triple or more, right, the value of the benefit. And it's still better than no strategic planning at all, right? We still have the ability to make that benefit last longer than the veteran does, okay? All right, so let's keep it moving here. So why not just use whole life? We've heard about whole life. You might have, kind of heard through some of the channels about the guarantees that are built into whole life. And that's true, right? We don't want to take away from any of those benefits, any of the guarantees. It is a different form of permanent life insurance. The regulations on how whole life is structured are a little bit different. It does include guarantees, right? But those guarantees come with significant trade-offs, right? And in many cases, it makes it less efficient for the goal of maximizing tax-free retirement income, okay? We can get into all the legalese about it, right? And all the reasons, a 7-pay test and, all this stuff. But the bottom line is that it is a less efficient vehicle for building maximum cash value because in most cases, unless there's a participating index option, you don't have any market-facing components to it. So you're only banking interest off of the dividends from the mutually owned life insurance company. So let's talk about it from an apples to apples perspective, okay? In most cases, whole life insurance, because of the way that it's regulated, is going to have higher premiums, right? Because we generally have to start with a higher death benefit. In most cases, we do. The premiums in most cases are going to be more expensive because, again, it's spread over, equally over a whole life, okay? That's where it gets its name, whole life. So instead of funding the policy and getting some support from the market performance, right, we're simply funding this ourselves. And we're basically creating a guaranteed death benefit out of a higher premium. Okay, that's basically how it works. In the early years, you generally will have a lower cash value. Now, there are ways to design a whole life policy that will have higher cash values in the beginning. But again, we're going to end up with a higher premium. So in most cases, it's going to take longer to really plus up the cash values in the policy. Okay, and then the big one is going to be limited growth potential. Whole life policies are generally only going to grow at about 3 to 5% a year. Okay. Now that's a safe return, but it's very modest. Okay. We can do much better. We've seen years in index universal life policies where you've earned over 20% in a single year. Okay. That, makes whole life pale in comparison. Okay. It's much less flexible. Much less flexible than IUL. In fact, that's why universal life was basically created in the first place. The flexibility was sort of the key component to universal life, so that we're not just locked into a level premium for the rest of our lives, right? We have the ability to put in additional funding. We can start with a lower death benefit. We can adjust death benefit very easily. We can include very cheap forms of insurance. Now, we can do some of that stuff too with whole life, but we have a lot more flexibility with how we design universal, okay? And then, of course, as a result of the limited growth potential, we get slow compounding, okay? Over time, it's going to build up. But when you compare the annual incomes, in some cases, we're talking, if you start early, we could be talking upwards of a difference of 60 or 70,000 a year of income between the two different structures of policies. Okay, with the IUL, you're going to get the 0% floor protection. I mean, granted, you're going to get that in whole life too, okay? But you're going to get that with a market-linked upside in a universal life policy. So again, we're leveraging support from the market performance to plus up those cash values year after year, okay? The goal is really maximizing tax-free retirement income. And frankly, the IUL just demonstrates a superior capability to do that, okay? You get better growth potential, earlier, higher cash values, better flexibility, and you still maintain that downside protection. And the way we design these policies, we keep the insurance costs to a minimum. That's the name of the game. All right, so it does make sense in some cases to use whole life. If a client is young enough, especially if they're in their early 20s or 30s, we can still use it because over decades they're going to, get pretty high up on that compound curve, so they can still use it. If we want to put a large sum in the first couple of years, or especially the first year, and we want to be able to access that right away to get very aggressive in dynamic banking, whole life might be the answer. Okay. If a client is interested in redirecting some of these funds for the purpose of investing in other higher risk markets, whether they be real estate, whether they be crypto investing, mutual funds, stocks, whatever, right? That may be a place where whole life makes more sense, right? Because you have a little bit more guarantee in the backbone of it. We can design it to be very conservative. And in the end, you're still going to net quite a bit of money. It would work basically like a savings account, but you're going to be earning a little bit higher interest than what you would earn in, let's say, a high yield environment, okay? If you want guaranteed growth, then, there you go. There's your guarantees. Your guarantees can be found in whole life. Okay, and again, if you're planning on using the funds very early for more aggressive investing in higher risk, right? Higher risk is the key, right? If they are higher risk vehicles that you stand to earn more money on and you can take a chance on potentially losing more money on later on, then whole life might be the answer. Right. So again, commercial real estate, business funding, if we're building again working capital for businesses, that may be an application. Although in most cases, most business applications, you'll find IUL still ends up being the superior product. All right, and now the big one. Why not just max out my 401k, my IRA, a Roth IRA, or the TSP? Okay, and this kind of gets to the heart of why traditional retirement planning falls short for so many veterans, right? Especially those with substantial stable income, right? Stable income is the key, right? From a source like VA compensation. The conventional wisdom would have us believe that maxing out your 401k or an IRA or a Roth, assuming you qualify, right? You guys know that Roths have income limits, right? If you make over $160,000 a year, you can't even own a Roth, okay, as an individual. So understand that there's limitations there, okay? These strategies have been considered safe and smart, but the reality is that they're all still subject to market volatility. They all still have significant limitations. And frankly, the financial industry benefits from these type of accounts as a whole, right? Which is why they don't promote strategies like what we're talking about here, like RETIREMAX ELITE, right? The banks don't necessarily profit from that, right? The major investment firms don't necessarily profit from that, so that's why they don't market it, right? But we have a better solution, okay? And that's what we're talking about here tonight, is the superior solution, right? So when we look at traditional accounts, okay, 401ks, IRAs, TSP, right? What are some of the limitations that these accounts have? Well, the first one is going to be full market exposure. So understand, we talked about this last week on the live stream. When your money is invested in these direct brokerage accounts, you basically own securities, equities, stocks, whatever, right? You own those, right? The only way to access money, actual liquid cash from those owned assets, whether they be, again, stocks, bonds, equities, whatever, is to sell them, okay? And when you sell them, you have to time the markets, right? Those same equities may not be worth as much when you go to sell, which is what we see when we see the market kind of dip and ebb and flow when you're on the roller coaster, okay? It's the same as owning real estate, right? You have no guarantees that when you buy your house today, that your house is going to be worth more in the future. And you know what? People in 2008 found out that lesson the hard way, right? The really hard way. They found out that your home is not always going to be worth more. In fact, sometimes it's going to be worth a lot less, okay? And the same with your stocks, the same with your, any other equities that you might hold in the markets, okay? So as a result of that, you incur what's called sequence of returns risk, meaning that if you're trying to, structure your retirement around this type of an investment strategy, you have to hope that the markets cooperate, okay? Because a 15 or a 20% dip in the market when you're drawing, let's say 5 or maybe 6% off of your savings in retirement can really be detrimental, because now it's going to take you a number of years just to recover from the 15% loss. If you're going along and you're drawing 6 and then all of a sudden it's down here, now one, you've got less in your principal compounding than you did before, and two, in order to be able to draw that same amount of money, you're gonna have to recover, right? You're gonna have to take a larger percentage in order to still draw the same amount of money, which means you risk running out of money, right? That's why we call it sequence of returns risk. Now, if you're under the age of 59 and a half, you're also going to have 10% early withdrawal penalties, okay? If you go to pull the money out of your 401k before you're 59 and a half years old, you're going to get an automatic 10% penalty from the IRS. TSP, incidentally, is also going to withhold 20%, okay? So just throwing that out there. Okay, those vehicles are also 100% taxable in retirement, even the Roth, okay? Because if you're contributing post-tax dollars, or let's say you're contributing pre-tax dollars to the Roth and you convert it later or you're contributing pre-tax dollars to the traditional and you convert it later to the Roth, you're still going to pay taxes on that conversion, okay? So in many cases, that income can still become taxable, okay? You also have RMDs, required minimum distributions. Guess what? Uncle Sam is going to get his cut, regardless of whether you want him to or not, right? So if you just leave that money in there until you're age 73, Uncle Sam, the tax man cometh, okay? He's going to force you to start taking money out. And if you die before then, guess what? Your beneficiaries, whether they be your kids, your grandkids, whoever, they're going to be forced to take the money out because, again, the tax man will want his cut, okay? You're going to have contribution caps. In a 401k, in an IRA, generally it's about $7,000 or $8,000 a year, depending on how much you make and what your age is. Okay, in an IRA, $23,000 roughly speaking for a 401k. You don't have any liquidity in these type of accounts during market downturns. So if the markets crash and you need money, right, you're not going to be able to access it without a penalty. In some cases, if you lose money in your accounts due to market downturns, you may not be able to access it at all, right? I mean, if the market completely bottoms out and you lose all the, everything you got in there, well, I mean, then you're not going to have anything at all, right? And of course, you have limited flexibility. So when it comes to even things like taking TSP loans, right? You guys might have heard about the TSP loan program. Look it up if you haven't. We'll do some future content on what TSP loans look like. It's a very, very rigid structure. It kind of is almost in the same vein as like a mortgage loan or even a short-term, whether they be a cash-out refi on a house, where now you have a very rigid structure. You have to repay it over a short period of time, and if you don't, you end up forfeiting the balance of your TSP. Okay, so they just don't adapt to life circumstances the same way that what we're talking about in the IUL does, okay? Because again, RETIREMAX ELITE is going to be market protected, it's going to be tax-free, and it's going to be liquid, okay? You're going to get all three of those all bundled up, plus you're going to get the legacy benefit. Again, veterans often overestimate market safety. What we've personally seen, we've had clients come to us that have lost over $100,000 and in some cases over $200,000 in the markets, right? We've seen clients that have lost almost everything in their 401ks in the past. And so they come to us because they want to protect their principal going forward, right? They want those market protections that are going to keep them sleeping well at night, not worrying about losing all that money again and losing their legacy benefits. Okay. Some of them have had their TSP accounts hammered. They've seen up to 30 to 40% drops. In 2008, the C fund dropped 40%. The S&P 500 dropped significantly. So we want to combine the market protections with tax-free access because that's how we obviously, one, mitigate loss, but we also maximize income, right? Think about adding an additional 25 to 30% of value onto your income because you're, again, accessing your cash completely tax-free, right? You're cutting Uncle Sam out of the equation 100%, right? So the IRS, again, under 7702, they know you've got the income, right? I mean, they track everything when it comes to every dollar that's coming in and out. I mean, unless you're doing something under the table, but, they're tracking every dollar of this, but it's not reportable on your 1040 form at the end of the year because, again, this is regulated, it's tax-free, it's 100% in accordance with the law, and for as far as we can tell, it always will be, okay? Okay, so what have we covered tonight? Well, let's recap. We talked about the, what does this look like if you're 60 years old? Okay, and in that situation, we were able to show mathematically a scenario where we delivered 3 to 4 times the value, right? If the veteran had simply done nothing except just collect their VA disability compensation and spend it every month, they would have gotten 3 to 4 times less than they would have gotten with RETIREMAX ELITE, okay, with our triple VA compensation program. Okay, we talked about what are some options if you have poor health, right? We've got VetLife, right, which is a specialized underwriting program for veterans with service-connected conditions. We also talked about surrogate strategies. So if you wanted to insure a spouse, a loved one, a child, even if you're uninsurable, you can still benefit from the cash value growth and you can still create a legacy benefit out of that, right? We talked about the differences between IUL and whole life, right? So for tax-free retirement income, a max-funded IUL is more efficient overall in most cases than whole life, okay? Whole life does have specific uses, but our go-to strategy is going to be the Index Universal Life, right? We talked about traditional investment vehicles like 401k and TSP, how they have serious limitations, they have market risk, okay, tax penalties, forced distributions, zero liquidity, okay? You do not have liquidity because you're going to get hit with penalties if you pull your money out of these programs, okay? RETIREMAX ELITE, our program, fills every one of these gaps, okay? You get market protection, tax-free growth, tax-free access, no penalties, no forced distributions, and the flexibility to adapt this strategy to real life, okay? You have the ability to reposition funds from your VA compensation that over time, even as you continue to access those funds, are going to continue to grow. We've seen a historical compounding average of anywhere from 7 to 9 or 10% in these type of policies, right? We minimize the insurance costs, we maximize the cash value growth, and you're still going to get a tax-free legacy benefit. And our goal is to triple or more the value of our nation's heroes' compensation for their service-connected disabilities and conditions. All right, so how does it all work together? Again, we redirect a portion of the compensation. We can do all of it if you want, but we don't have to do all of it. Guess what? That's part of the flexibility, right? We can just do some of it, right? And if we just do some of it, we're going to accelerate the growth, potentially triple or more the growth on just that sum. You'll still be receiving the rest, and then at the end of that period where we fund it, then you get to reclaim the funds that you were directing all the while. Pair them up with the funds that you're now receiving in the accelerated fashion, and you will benefit tremendously from this. So you get tax-free growth in the policy. It's going to be protected from any market downturns. You can access the funds while it's compounding. And in the end, you're going to reclaim your full VA compensation. You're going to take tax-free income from the policy. And at the end of your life, you're going to be able to leave a tax-free legacy to your beneficiaries. Okay, so that is a totally separate death benefit from your cash values. It's not strictly your cash value the way it would be if it was a 401k, and it's not going to be taxable, right? It's going to be tax-free to your beneficiaries. What could be better than that? Okay, so again, a complete financial ecosystem that's designed to add roughly anywhere from 20 to 80, possibly more, 80,000 a year in annual tax-free income during your retirement, depending on, of course, your health risk, your age, and how well and how much you fund the policy with. Okay. So if you guys are interested, right, we get to the fun part. If you are interested in learning more, and we've had a lot of veterans reach out that have been interested in these policies. So check out some of our other videos on YouTube. Again, I will link the original video, the triple your VA compensation video in the comments. But we can run your numbers. Okay. Again, this is 100% free consultation. We can offer, our soundest advice on how to go about this, how to get started. Even if we don't end up doing business, that's okay. We are in the education space. I'm all about empowering veterans with the knowledge to be able to use these type of strategies. So if you want to learn more about this, there's a link down below. You can book a free 30-minute consultation. I'll call you. You can set that time whenever you want to, book on my calendar, and we'll give you the projections, okay? And I'll tell you if I don't think it's a good fit, but in most cases, I think it's going to be. Whether you're 30% rated, 70% rated, 100%, doesn't really matter, right? We look at this from a holistic perspective. We align this with your goals, and we can tell you what your numbers are going to look like, right? And what are you trying to do with it, right? So are you focused on just building retirement income? Are you focused on building a legacy? Are you focused on funding a business, right? We help veterans build businesses. That's part of our business. And we can certainly incorporate these type of strategies into those plans to help veterans, again, accelerate and really amplify their service long after they've left the military, okay? And again, we calculate this all based on your specific timeline, based on your specific goals. So again, click the link. You see that on the screen, or you can just click the link down below in the comments. Book a free 30-minute strategy call. You can do it at your convenience, right? But I definitely encourage you to do it sooner than later, right? Because again, when we're talking about life insurance, we're all getting older, right? And the older we get, the less efficient this becomes, right? I know we talked about a 60-year-old, but if you start this stuff at 30 or 40, or even 45, etc., the numbers are absolutely astronomical, okay? We're not just talking about tripling, we're talking about like 10xing, right, or more. So it can be extremely powerful. So if you're thinking about doing this now, don't wait, right? We have strategies. If you're not in the best position right now, we still have strategies that can get you started with a very, very modest, contribution in the beginning, so that at least you're putting something aside, right? At least you're doing something to build your legacy for the future, right? If you guys are interested, go ahead and check out. If you didn't get a chance to watch last week's live stream about how veterans can save big on life insurance, check that out, right? We've got videos on the YouTube channel. I even linked a couple of the videos on the Facebook page, but check that out because again, we have strategies that can pretty much meet any budget, okay? Just don't do nothing, right? You saw the cost of the opportunity here tonight. Don't do nothing, okay? So again, final notes, we don't charge any consultation fees, and that's ever, right? Ever. I don't have to, right? We get paid, we get compensated by the carriers separately from the money that, is being put into these policies. So I'm not charging my clients a management fee for any of these policies or any of these consultations. And we have an ongoing, client to professional relationship, and we do constant monitoring of these policies. We're constantly, we meet with our clients on a regular basis. to provide, mentorship, to provide, counsel, advice, etc. And we manage these policies year in and year out, and we don't charge our clients a dime for that. Okay. Again, no pressure. I'm not going to sit there and chase you to try and get one of these policies started. But I will encourage you to, again, just consider the opportunity costs of doing nothing, okay? We're not about playing sales games. I'm just about speaking the truth, okay? And the truth is, the sooner you get started, the better off you're going to be, okay? And in the end, you're going to leave with a plan, right? So even if we don't do business, you're still going to have a plan. If you want to take that and run with it, that's up to you. But I'm all about, like I said, educating, empowering with knowledge, and that's what we are all about as Victory X Financial. Okay, because you served your country, and we believe that you deserve access to strategies that can truly transform your family's financial future, your financial future, long into future generations after you're gone. Okay. All right, guys. So that's about all we have for tonight. Okay, just a few closing thoughts, right? The veteran community deserves better than just a one-size-fits-all financial advice that gets dominated by the mainstream media, okay? You deserve strategies that are designed specifically for veterans, by veterans, okay, that understand that compensation structure and understand the challenges that veterans go through, okay? I understand the strategy is not for everyone. I totally acknowledge that, right? It does require some discipline. It requires some long-term thinking, right? And some willingness to redirect the money. But if you do that, you guys just saw here tonight, right? Watch the original video. We talk about the math. Watch the follow-up video, the part 2, right? We show the math, right? That's what we got into tonight. If you do this, the results speak for themselves, right? I mean, you could easily triple or quadruple the lifetime benefit that you're receiving, right, as a result of your service. So if you liked what you saw here tonight, okay, if you understand and you want to learn more, I encourage you to share this, right? Share this video with a fellow veteran. Even one share, right, could mean the difference between somebody being able to unlock the value of tripling or quadrupling their compensation benefit. Just one share could do that. So please, when you see this video, right, and you start to understand and the wheels start turning, feel free to reach out to the folks that you interact with on a daily or a weekly basis and just say, hey, I saw this video the other day, and I really think that you should check this out, man, because this is one veteran speaking to another, right? This is one veteran sharing, speaking truth to power and sharing this extremely valuable knowledge that none of us got while we were active duty. I wish that more people did, right? But they just don't get this. So again, you have the power to share this message, and so that we continue to promote financial literacy within our community and we continue to lift each other up, right? Because you never know who needs it. So please feel free to get this information out there. So again, I'm Dan Farnsworth, and one more time, if you guys comment wealth on the video, I'm going to send you a free copy of RETIREMAX ELITE, right? Our veterans guide to tax-free wealth and financial freedom. The book's on Amazon, but I'm going to send you that here tonight. So comment wealth down below, and we will be back next week. I hope you guys have a great Thanksgiving this week. It's a wonderful holiday. Enjoy your time with family. And we will see you guys again real soon. As always, stay sharp, stay ready, and I'll see you in the next video.